Welcome to Trader TV. I'm Dan Barnes. Portfolio trading boomed in March during the sell-off, but Ray Uy, global head of fixed income and currency trading at Invesco, says that portfolio trading has value all year round if used in the correct way. Today we're going to be discussing how Invesco is using it and why it's expecting its volumes of portfolio trading to double next year. Ray, welcome to Trader TV.
Hey Dan, glad to be here. Thanks for having me.
So tell us, how have you seen your execution priorities changing over 2020?
Very subtly. I think we've always had an emphasis on looking at technology, looking at developments in the markets to refine our strategies. And for us, the emphasis this year has been on leveraging that technology towards the deployment of a systematic toolkit for execution. Mm-hmm. Portfolio trading falls within that toolkit.
And so what effect has that had on the trading protocols that you use? You mentioned portfolio trading there.
The traditional RFQ as well as voice, still exists. Obviously, within credit, primary credit trading is still a very huge part of the overall activities. I think portfolio trading has almost had hyperbolic growth over the last 3 years.
Yeah.
In terms of a much more efficient and useful tool that can be deployed in secondary trading. And depending on the type of execution, a very useful alternative to the traditional protocols.
What sort of trades do you see it working best for?
Given the market structure, really the sweet spot for portfolio trading and fixed income is in credit. The two factors that generally drive the best outcomes are a function of liquidity and diversity, right? Mm-hmm. So if you have a diverse portfolio that has reasonable liquid characteristics that you're seeking to trade, that's a very good starting point, all right? And then you can overlay that with, is the risk profile compatible with other passive vehicles in the market? Probably the greatest factor ushering the growth of portfolio trading is not only the utility on the buy side, mm-hmm. but the utility on the sell side in terms of how they're thinking about their risk management. And it's sort of broadened that opportunity set for them to manage their risks from their market making activities by integrating other channels.
That's great. Thanks very much. Now, we've seen the portfolio trading protocol being popular both on electronic platforms. We've seen sort of electronic liquidity providers who are very focused on the ETF space providing it, and traditional dealers as well. Do you see all of those as being useful avenues to supporting this as a protocol?
Yes, I think really it's been a tailwind for newer fixed income players that had historically been more tied to the ETFs. Mm-hmm. The technology lift on the sell side to get this working well wasn't insignificant. And I think some of the, ETF market makers were organized in a way where their books were consolidated. And so they could engage in this model much more seamlessly at the start. Now, the traditional firms that generally had more fragmented structures with different sector desks, et cetera, they've come up the curve very quickly.
The thing I think that's most interesting about portfolio trading is perhaps that it doesn't rely upon some sort of instantaneous liquidity, which typically you don't get in credit. So it does seem to have a more natural fit in the corporate bond space.
Yeah, I think it created a nice framework for both the buy side and the sell side to look at line items and the risks associated with that on an aggregate basis.
Yeah.
The traditional OTC structure, fixed income, is by phone, it's individual line items. And if you're a trader, you're working each line item and really negotiating and engaging. And I think there's still value to that. But portfolio trading is a good lower touch tool that is really efficient at solving for like very basic things, cash flow management. And 10 years ago, if you won a huge mandate, it might take you a month to invest.
Yep.
But with portfolio trading, you've shrunk the window down to hours. And by shrinking that execution window, you're really reducing any tail exposures or any potential for an exogenous shock to really impact your outcomes.
We've also seen a lot of positive commentary around the certainty that it provides. And when we had the sell-off in March, obviously People aren't looking for price improvement in the sell-off, it's a question of getting it done. So that seems to fit well across different scenarios then.
You had a good test scenario to see where the limits are, right? And I think two things. A, it's performed better than everyone expected initially in volatile markets because everyone thought, this just works when things are calm. So, we're able to refute that with real empirical evidence. But fixed income markets are still driven by capital and by, to a lesser extent, supply and demand, obviously. So those are still very real constraints. And for the majority of outcomes within calm to volatile, it works well. But in the extremes where if nobody's making markets, it doesn't really matter.
Yeah.
No portfolio trades are getting done. So I try to be balanced about, it's a great tool. It's not a panacea for everything.
Of course. That's great. So what sort of volume do you think you might be putting through portfolio trading next year?
We've been doubling, right, each year. So we started 3 years ago from nothing, a couple of billion to 5 billion to, 10 billion. It's almost like Moore's Law.
Yeah.
I would expect us to double our activity next year. And so 20 billion, that would be a very easy threshold.
You mentioned about how this is benefiting clients. How do you see Invesco's investors overall benefiting from the more diverse execution capabilities you have, including portfolio trading?
Because we're able to transact this efficiently, the range of solutions we can provide to clients expands. And from the simplest passive strategy to the most complex active, an implementation tool such as portfolio trading really bridges that continuum. Our portfolio managers, our product people can be as creative as they want. And if the market structure is compatible, then portfolio trading is a very useful tool in helping deliver those outcomes. And in fact, this year, we were very successful with a very prominent institutional client, and the differentiator was our capabilities in this space.
That's fantastic. Great. Thanks very much.
Thank you.
I'd like to thank Ray for his insights and, of course, you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net or etftv.net.